Come along, come along, come along. Let's go.
Welcome to the YRG podcast. This is Nasser.
My name is Joe. I'm going to be gentle today.
You're gentle every day, don't worry. Welcome, guys. We're glad to be here again, talking about how everyday Canadians can build wealth through real estate. So
Just going to do a recap of episode 1 we're talking about, investing in real estate today. So we had the episode 1.
Okay, so part 2 now.
Part 2, where we spoke about the different opportunities, from land, everything about land, the value of land, how the land appreciates, and how you can get better out of land, right?
Right.
So today we're going to, taking a deep dive further into the various investment opportunities. As you know, our goal is to keep serving you the right nuggets, the right information for you to unlock real wealth, like I always call it, and that's land.
Absolutely.
Anything real estate is real to me. Like they always say, nothing is as real as real estate.
Who always says you?
Like me.
You always say.
Like I always say, nothing is as real as real estate.
Good.
It's the realest thing you can ever be real with.
Yeah, it's a tangible asset for sure.
Very, very tangible. Very tangible. So I'm just going to ask, what does the market look like right now? Upside, downside, what's it looking like?
Are you speaking with respect to investing in real estate or just real estate as a whole?
As a whole.
As a whole. Well, if I'm being honest, the market has been pretty soft so far. I know we had discussed this in the previous episode where because of the tariffs, that's causing a little bit of uncertainty. Actually, not a little bit, a lot of uncertainty in the market, right? And so demand has been a little bit subsided in terms of people are just kind of like waiting to see what happens. At the same time, what that has caused is house prices have clearly gone down. I think everybody knows that now. People are seeing prices that as at maybe a year ago they went.
I'll say it's on sale.
Yeah, the market is on sale right now. Which brings me to a very important point. I say to myself, when stocks are down and shares are down, people always shout, "Oh, buy the dip, buy the dip."
Yeah.
Why don't we buy the dip when it comes to real estate?
This is Warren Buffett. That's what he said. He said when others are sleeping, that's when you're making money. In real estate. Either you want to buy, you want to hold, you want to sell, you want to buy again and hold. That's a strategy.
So I think we should be taking advantage of the market right now. And we're not just saying that just because we're real estate agents. Everything is clearly on sale right now. It's clearly on sale right now. And that being said, some people in some particular markets, because you asked how the market was, are making moves. Demand is gradually increasing. Not at last year's pace or the year before, but demand is gradually increasing. And I think as the year goes by and most importantly, as the tariff wars or whatever it is settled once and for all between Canada and the United States, I think after that, we're going to see a very, a sharp turn in the market.
Yeah,
so
it's going to be very...
But you don't want to wait for that to happen because it's already too late at that point in time. So
I don't think anyone should. But again, people need to look at their situations, right? Peculiarities of what works for them and then be able to, But like I said, there's no time that is ever late.
Right.
The
best time to invest in real estate is today. It's now.
Yesterday is late already. Yeah. So today is the next good time for you to invest in real estate. Yeah. So today we're going to be looking at, what are some of those things that people need to just be very mindful about, just to know before you jump into that investment. It's good for you to have a few understanding of the key drivers of the market. So things like interest rates.
Right.
Yeah.
So I think interest rates is definitely one of the key things, especially in today's market, right? We see, I was talking to a client where in the interest rate was what basically determined if their investment decision was a good one or a bad one. So what had happened was the client bought a property in Hamilton for a particular price, right? And then at that point in time, I think it was 2022, interest rates started to climb up gradually. And so even though they bought a property that was cash flowing in the sense that all the expenses were being covered by the rent they were making.
Yeah.
Right. And they were cash flowing. I think they were like $200 in the positive. But because of that creeping interest rate, and because they were on a variable rate, which fluctuates with the interest rate announcements of the Bank of Canada, their cash flow literally went from positive 200 to negative 1,500.
Wow.
Yeah. And so that speaks to the importance of when you're buying real estate, it's not just about the property itself, which I'm sure we'll dive into. It's not just about the down payment. It's not just about qualifying. It's also about having the right interest rate product on that property. So you don't find yourself in that situation where you have to be paying out of pockets to cover the mortgage or any other expenses for the property.
Yeah. And I mean, and at a time where we have the BOC policy rate at 2.75%. Right. And then for mortgage, you're looking at about 4.95 or 4.75%, right? Prime rates, right?
Roughly, yes.
I mean, there's a possibility that, forecast is like 60-70%, like the rates might, can go backwards again. So what does that mean for an investor? Is the fact that if you're very familiar, understand the market, the way it works, you know that there are two key drivers that drive the real estate market, even on the very plain level: interest rates, demand and supply.
Absolutely.
Now, if the rate is at 2.75 BOC policy rate right now, and it goes, so it tells you that there's some positives, right? So if it goes backwards, let's say probably 50 basic points or 70 whatever basic point the bank goes by, the impact is that there are more people that could jump into the market, right? So for you as an investor, what does it mean for you? Now, if for those that have already, it's a good value, right? For those that don't have, it means more purchasing power is going to be getting off your hand, because now it then means that you have more money to buy because you want to invest, right? But again, from the mortgage perspective, it's different, because if it's going to be investment property, there's an approach in which how they measure your qualification,
right,
as compared to a primary resident. Sure. So you can see the dynamics are very, very different, right, when it comes to investment. So what's the key takeaway for you as an investor is the fact that sit down, analyze what you're looking at. Is it a long-term investment? Is it a short-term investment? What do you want to unlock, right? And then as we delve in, we're going to talk about the various opportunities that are available in different kind of properties, right? Either from a condo, the kind of things we're seeing in the market from a condo perspective right now. Is it a good time? People have been asking, is condo on sale? Is condo crashing?
We'll dive into that.
We'll dive into that,
because
right?
that it needs its own episode.
Exactly. So I think for me the key thing is right now we have to kind of people in the market. Those that are holding,
right,
who don't want to sell. Why don't they want to sell? Probably they bought at a very high price, and I feel like it doesn't, like, selling right now might not be good, because it's more like a buyer's market right now. So for you as an investor, you have people that are hesitant to sell, right? What if you go a little bit higher? Now, what I mean is that many people right now are trying to buy lower,
right?
And because of that, most people are holding a property like, I don't want to sell. For those people that haven't had it for too long, for those that have held it probably for like 10 years,
right,
they might want to sell. Enough equity, they've paid it off almost to a good extent, so they want to sell. They wouldn't mind to go buy something that they've made a good chunk of profit from it. For those that probably bought in like 3, 4, 5 years, they might be holding, because again, they probably bought at a very high amount,
high rate as well,
and they don't want to sell. Now, for you as an investor, the approach I would deploy is, if the market is looking at about a property that is probably like at about 550. I'll probably go at 570. It may sound like it doesn't make any sense, but from an investor perspective, it's not a short-time ownership. I'm not holding for a very short time.
You know why you're buying it. Yeah,
so,
what you're saying.
So it's only $30 more, because I know that once the rate goes, once we have another 50 basic points, the impact is that properties are going to go higher.
Yes, and that you get that spike back almost immediately.
Get you.
Yeah.
Right? So for me, I'm already kind of ahead of the market already. I'm not waiting for everyone who is scared of looking to buy very cheap. Though I'm not buying too expensive. I'm still buying a little bit, affordable. Because ideally, a 30K right now is not still bad.
Right.
Again, I won't say that to a primary resident owner. I'll say that from an investor perspective. Right? So you're thinking about the margin.
You're looking at the numbers.
You're thinking at the number. Looking at what the reaction of the curve could be if the interest rates keep reducing. The market is going to be against you. Right, from an investment perspective, if you want to invest. So for me, that's going to be my strategy: to sit down, run the math. For an investor, don't get scared. Just do your analysis, do your capitalization rates, and be very sure that it just makes all the sense. 30, 40K more right now for you to bargain for, it's a good deal for me.
And I'd like to dive deeper on that, because you said something. So you said do the math.
Yeah.
So I remember I had a conversation with the client, because they watched the previous episode. I told you about this, and they were like, okay, he would have loved if we dived deeper into what the math looks like. So let's talk about the math, right? If someone is looking for an investment property to buy, either a rental property, what numbers should you be looking at? And it's very simple. The number one expenses is basically, think of it as income and expenses.
Yeah.
There are two line items: income, expenses. It's that simple. And whatever the difference is either your profit or your loss. from an income perspective, how you generating income from the property, rental payments, if you're putting tenants there. This is if you're buying a house that has, let's say, an upper unit and a lower unit, right?
Yeah.
So you have those things. So you already know what the market is demanding for that particular 3-bedroom unit or 2-bedroom basement unit as well. So that's your income side of things. Now, the additional things you can add to the income, like if you want to decide to rent the garage out, because now you have 2 tenants, so whoever gets the garage, maybe you want to add like an additional $50, $100 fee. Because I've seen landlords do that as well.
To lease out, right?
Yes, you lease out.
I have someone just. Yeah. Guess what? Just to jump in there, I have a property just very close to mine, and it took me a while to know that it's a garage.
Oh wow!
Completely like.
And they're just renting it out.
Yeah.
Any income from the garage. Yeah. That's
you probably would never know it's a garage.
Wow.
Because the doors are removed, converted, given a very good facelifting, normal standard, entrance door, and. I mean, I lived there for almost like 2 years before I figured out, something is going on here.
Something's going on here.
Because I see someone, someone just coming out of the house, and I've never thought about it as a guy. So just to say that's very, very possible.
Yeah, possible as well, yeah. So there's that as well. So that's the income side of things, right? Then the expense side is obviously your mortgage, except you paid cash. You have to be servicing that interest rate expense. So there's your mortgage, there's your property tax, there's your property insurance, because people forget to run these numbers. For the utilities like your gas, your hydro, your water, you don't need to worry about that because the tenants will be paying that expense, right? So you don't need to factor that into your whatever expenses you're paying. What else are you paying?
Property tax.
Yeah, I already mentioned that. So property tax, your property insurance,
and
your
you're keeping some
expense.
money for maintenance.
Yes. So and this is why you have to make sure that whatever income you're using, income numbers, right? You have to ensure that you keep like a portion of that as reserves. In case something is broken, so every month if you're saving like $100 or $150 somewhere, you can use that to service those costs or those maintenance expenses. So it's good to know. That being said, if I'm being completely honest, it's hard to find a cash flowing property in Toronto right now. It's
hard.
So we need to be creative.
But in the long term, right, it will cash flow. I think probably what I think we have is that most investors are not patient for like rookies, people who are just trying to get into investment. Right. Like if you don't have the right understanding about how real estate works and investment side works, you probably get agitated as to what's going on.
Because COVID spoiled us. We thought house prices increased by 20% just in 1 year,
Absolutely.
which is not the norm.
Absolutely. So if you understand the way investment works, it's a long-term approach. It's not an immediate, like you want to rent out and you want to break even almost immediately. If you break even, God bless you.
Yeah.
Immediately. But it's because, again, the intention is not the $100 you want to be making that you're looking at. It's not the $50 you're making. If you get that, that's beautiful.
Right.
So, but that's not why you went into buying a property for investment, to be making $100, $50.
But again, people have different reasons. Maybe someone went in for the cash flow.
Which is what I'm saying, right? Okay, well, that's fine. I mean, again, which is what we talk about. Different people have different understanding,
right?
So for me, that's your own position, right? Which is very, very solid. But for me, I'm not going to get into a property because I want to make $50, $100.
You're thinking of appreciation then.
That's it. That's a big deal for me because it's gonna be like a big blow at once. Right. So if I buy property for like example $500,000, if it doesn't cash flow immediately, again it mustn't be excessive to say that I'm making $2,500 and I'm paying $3,500. That's not a good deal. You probably didn't get you didn't run. Again, we could talk.
So what do you mean by you're making $2,500? Are you saying you're making $2,500 in rental income?
Yeah. So let's say
the mortgage is $3,500.
It's $3,500.
Okay, so you're short like $1,000.
Or probably all the expenses, property tax, condominium fee, as the case may be. If it's a condo, it's about I'm paying, which means out of pocket. That's you're negative $1,000 every month.
Got you.
Now, for someone that is at the immediate level, it might not be a good strategy because. I mean, if you were to be putting $1,000 in an investment every month,
especially in another asset class,
that'll
be returning more.
It might be returning more, right?
Got you.
So for me, we have to review that portfolio.
Got you.
And look at what is wrong.
Oh, I love that you said that. That's amazing.
Yeah, because in some instances you might have to liquidate and just move on.
Right.
Because if you can project and see that, you know what, I'll likely continue this way. What kind of property it is? Is it going to appreciate at that same speed,
right,
or at that same rate? So, because again, people don't know that. No investment have to be. You don't have to hold it for too long.
No, there's a time frame.
You have to recycle.
Right.
Look, if it's not making sense, if it's not hard enough, you let go. Otherwise, you're at a better saving grace than to continuously keep paying that negatives, which you might never cash flow. Probably it's a wrong property you bought.
Right.
The location is very, very wrong. The possibility of appreciation in that same location, because again, be mindful that location to determine appreciation in some instances.
Yeah, absolutely.
They impact each other, right?
Right.
So if you don't, which is why it's very good for you before you jump into. I'm trying to think about it. So investment is very, very different from a family resident property. The strategy, the approach, it's like you're a business owner. You have to sit down and look at your maths, look at the possibility, count the cost,
right.
Do your projection analysis, be very sure, okay, now I want to hold for 5 years. Do your market prediction to say, okay, what has been the growth like in the past 5 years?
Right. Every year, what has
it look
appreciated
like?
in this particular neighborhood? Yeah.
Mark that up, how much you're buying for. Mark that with the expenses you're spending every month, and be able to do a 5-year projection to see what that look like for you. Which is why it's not something just like I want to buy, just jump into. It's different.
Which people do a lot. They just think I want to invest in real estate. They just buy property.
Yeah.
But there's no exit strategy. There are no cash flow projections.
And then you'll be expecting ROI, and you're like, I don't understand. No, sit down.
ROI.
You have to build that frame. It's like a business case. You have to build. It's not something you just jump into because just like that. You have to look at, analyze the factors. Does it make sense? Location wise, does it make sense?
Right.
Interest rates, does it make sense? What does the economy look like currently? Because again, if you're familiar with the economy, it's always like a circle.
Everything's inside.
So you need to know what cycle are we right now.
Yeah.
What does the policy of the government look like? Either from an immigration perspective, because again, one thing that drives is immigration.
And that's huge right now, actually.
Yeah.
That's huge right
so is there a cut on immigration?
There is.
Or is there a rise on immigration? Again, that's number 2. Number 3, what part of the city or the province or the state, if there's immigration support, where are they going to? Is it within Ontario? Is it within Vancouver? Is it Calgary? You need to be able to look so that for you again, in investment, there's no sentiment.
Positioning.
Exactly. This is your money for your mouth.
Right.
So there's no emotion of I love Ontario. I love Calgary's code. When it comes to investment, it's not about you.
Right.
You're thinking like a business owner. So your business sense has to be as sharp, as sensitive as anything else.
Right.
So you're looking at it. So all this policy, immigration policy, are there government release programs, first-time home buyers plan, rental in that same area? What does the business outlook look like?
And then tenancy laws as well.
Tenancy laws. You're looking at it. Does it look like there's going to be more businesses coming up in this area? Is there any? What's the news of economic outlook saying
for this particular
city? Are they pumping in? For example, you want to look at So it's quite a lot of factors, right, that you have to put into it. Let me take a pause so I can. Because I'm very passionate about. So I'll go on and on to analyze. Because
you're touching on all the right points. Just to add to that as well, just to transit as well, right? In terms of developments, where is the city going in terms of expanding transportation infrastructure as well? So, like now, for instance, I saw a news report that spoke about Mississauga is getting like this $16 billion. I don't know if you saw that hospital.
Yeah,
that's a pointer to something.
Yeah.
So
because what that means is that more jobs.
Yep.
People want to stay pretty much close to work.
Yep.
Okay. Traffic is going to has an impact. Traffic impact as well.
It's going
to need more housing. Okay.
Right.
Exactly.
So things like that. Yeah. So those key pieces of news. I guess that's a tip for everybody. When you hear news, don't just, especially as an investor, you need to be very, very sensitive to what you're listening to. Don't just brush oh yeah, they're getting a hospital. That's nice. Oh yes, it's good. But then also think of it from an investment perspective that this hospital that they're building here, there are a lot of ancillary services that are going to need to support this hospital. And then from a real estate perspective, that might be something worth looking into.
And the funny thing again in this particular part is that people think about investment or real estate as just buying a property. It could be a business you want to set up in that location.
That's a good point.
For example, in an hospital environment, think about corner shops.
Right.
Convenience stores, we call them.
Or labs. Have you ever thought of labs? People that run all this life labs kind of situation. Because hospitals they don't do it in the hospital.
Yeah.
They just ask you to go somewhere.
Right? So think about owning the property, not residential now, commercial.
Commercial units.
For this kind of businesses. Convenience stores, labs, where shoppers, drug marts, pharmacies could come take a lease on you. So it's not just I want to buy a property for residential. That is one part of it.
Yeah, but in Canada, we're heavily biased towards residential property.
Yeah,
because that's what the banks push for the most part.
But think about it. For me, if I was to have both options, I would prefer a convenience store or a multiplex.
Why?
because it's a business.
True.
And before a Shoppers Drug Mart will come to a location, you can be sure that they've done a lot of strategy research. I mean, it's very clear to them that because they come every day, they just come and shut down. Right? They know that there's something.
If they're there for decades.
For the business. They've seen a business there. Yeah. So for me as a person, how am I positioning myself there? I don't want to deal with the rent of, I could live a Shoppers for 10 years. Right? I don't want a rent of monthly rents. Today, landlord tenancy, what do we call them?
The board.
The tenancy board, get into a rock tenant. That, of course, they don't. Sometimes life happens to people. It's not like they intentionally want to come to you, I don't want to pay rent, right?
Default, yeah.
But that will happen to Shoppers Drug Mart.
Hardly.
That won't happen to a Nike store, right? Because I'm not going to be listening for them on a month-to-month.
Got you.
Do you get what I'm saying? So there's a whole lot of things, and you don't have to do it alone. You can come with a group of people. Doesn't have to be. I think again, it's a point of people
that's huge.
You don't have to do it alone.
Yeah, that's huge. That's
right?
a very,
you
very
can
huge
run.
point.
You can go with people,
right,
to leverage each other, the funds, and then you do your percentage share ownership and the value of it. Right?
I guess the fear with that is the fear with, especially in our community, the fear with that is people are. But I think the narrative is changing. But I would say the fear is, I don't want to get into business with somebody and then it becomes a headache for me, right? I can't trust this person, I can't trust that person. But I always tell clients that you need to understand that this is like, we have professionals, we have like the rule of law in Canada, okay? Yeah. There are lawyers that will draft up all these agreements.
All the agreements. So it's not really your headache.
It's tight, right? Yeah, they make it very, very clear and plain. And if there has to be a dissolution to say, okay, we're not doing any more, there'll be terms and conditions that are stated in there to say, okay, these are the rules under which someone can leave. And if someone doesn't wants to get out of the deal or whatever, all they need to just to buy you out and go their own way.
Yeah. So, yeah. And there's no sentiment. Again, I keep using the word sentiment.
Right.
I think it's similar to the different kind of things or assets you want to buy that or liabilities that you don't buy them for sentiment. For example, cars. You don't buy a car based on sentiments. Right? A car is a depreciating asset. So you buy it for the use of it. At least for someone that
for the utility.
For the utility, not really. I love Benz. Also, I mean, I'd rather go buy shares in Mercedes Benz than to drive a Mercedes Benz. Right? I'd rather go buy shares with Tesla than to drive a Tesla.
Some people would disagree. Some people love Teslas. They love.
I mean, Teslas. That's fine. Which is why I said when it comes to investment, there's no sentiment.
There's no sentiment. Got you.
Right? You have to be. It's about the profit. It's about the numbers, and it's not about I want to do with my brother. If my brother doesn't allow my value system, I'll find someone that's not my brother.
You find your brother.
As long as you become my brother, we'll become brothers. Right? Because again, like I said, when it comes to business, your thinking has to be very different.
Right.
Again, people that share common value with you, it's very critical to work with them. And when I mean value, people are not too greedy. Because people might want to over leverage.
Got you.
And then it hurts.
Yeah.
Right? Some people are not risk takers. You also hurt. Some people are excessive risk takers.
It could hurt.
So you need to find people that have clear financial understanding of business, how business works. You don't miss pleasure with business. Business income, you don't take it to go buy Tim Hortons or to go run a party. Or you have to either you're ready to account for it.
Actually, you have to be
on business.
You open a business account, right?
So things have to be done properly, right? So yeah, and I think for investment practice, it's quite a lot. It's like with someone we can touch all on in here. It's like a school of opening up what the market looks like. Like as I've spoken about the location, I've spoken about the geography, I'm talking about, for example, if I was to hear that General Motors, for example, is opening a new plant, I don't care where the location is. I'm going there.
Why?
Because I know that the way they operate is they run shifts. So people don't want to stay people don't want to live very far
from work.
And oftentimes the first few years people want to rent. So for me, that's a rental opportunity. Or I hear of a university or a college
opening a new campus here.
Opening a new campus there. I'm going there.
And that speaks to another aspect of residential investing, which is student housing.
Yeah.
I know people don't like to really deal with students, but it's a need. Students need housing, right?
The university cannot afford. I mean, the college cannot
house everybody.
Yeah.
And so there's also that need of, even if you're buying like just a single family house, it might be as simple as just dividing the rooms into. I know investors that have divided one house into like six or seven rooms, right? Yeah. And they rent each room out for like $700 or $800, and then they're able to cash flow and make some money off that as well. Also, I know with student rentals, it's important to have policies and structures in place.
Yeah,
that is the key thing with student rentals, because people find it and people just expect them to know what to do. But how many of us were babying ourselves when we're students? Students they're still going to do what they're doing. They're still going to party. They are still going to invite friends over. But you can set guidelines and set rules and maybe even put a system in place. Maybe you have to send a cleaner to the house once every 2 weeks. Send someone to cut the lawn once every 2 weeks. Put a policy and procedure manual that students have to sign to say, in this house, there will be no parties. Even if they do it, because you have it listed in there. There'll be no parties, there'll be no smoking, there are no pets allowed, no guests staying over for longer than three days or 48 hours. Please respect everybody's privacy. And if it does happen, then you give them a quick notice.
And I think for US, for example, I know some investors in US where they have like a JV program where some investors were allowed, some real estate properties owners were allowed to build on the university land.
Oh yeah, okay.
And they had a partnership with investors.
For the investor itself.
Yeah, so it's not investor property, but the investor gave them the land, and which purpose is to subsidize the rates.
And then they
for the students, and it kind of makes it much easier because you're guaranteed of. It's a sure.
And it's there for years.
The student cannot afford to mess up with investor property, right? So it's kind of like a leverage for you, right? So I think people should just be very open-minded, do a lot of research, look at the opportunities that are available. I'm sure there'll be things that are also available, here in Canada, that people can leverage. Even probably just because if you go to investors, they have some land within the probably they haven't exhausted, and you never can tell. Come with a very solid proposal, and look at the investor can see the value of what is in it for them. Right?
And they can dive into that as well.
They can dive into it. So let's talk about what are some of those, investment strategies, right? That people can really look at. I think I already spoke about joint ventures already.
Yeah, absolutely.
Partner with people. I think there's a part of buy and hold. So what does buy and hold means? Basically means that, again, you're doing your forecast, you're doing your planning. It could be a land, it could be a property. So let's talk about properties, for example. You buy a property and you've done a clear framework how you want to pay your mortgage for the next 5 years, right? And again, you're thinking about the investment part of it, like the margin, the profit, the ROI that's going to come up. And like in 5 years, you can foresee probably 20, 30%, increase
in the property.
That part. So that's the kind of what you want to buy and hold. Now, there's a part of where you want to buy, and then you do a short-term plan, okay, to just get it and let go.
Which is like a flip.
A flip, right? So there's that option as well. And there's also the pre-construction project. Do you want to talk about that? I know we spoke about that previously.
Yeah, so pre-construction is when you...
And why is it beneficial?
It's beneficial because it's riskier. It's riskier for sure. Because basically you're buying pre-construction, like we discussed in the last episode, not to hammer too much on this, but you're buying a property before it's built. There is no guarantee that the property is going to be built, even though we are trusting that the builders will finish up on it. So for that reason, it's risky. Also due to the fact that you're putting a lump sum down, right, for pre-construction.
Yeah.
But the beauty of it is when the builder does finish that project or when they are done building, if they start building, let's say they started building last year, which is 2024, by the time the property is ready for 2026 or 2027, all things being equal, if the market follows your projections and you bought it in a good location, the premise is that what you paid, the price you paid for in 2024, by 2027, it has increased by, let's say, 5 or 6% every year. And so your property has appreciated even just on paper, right? So that's the benefit of investing in pre-construction real estate.
Yeah, I think another thing for me with pre-construction is that if you look at, if you go through documentation properly, you have where you can assign.
Yes.
Right?
Yes.
So
but that shouldn't be the goal, please, because people thought they could assign and then they couldn't find buyers in the market.
Yes.
Yeah.
Yes.
But you can also assign.
I mean, if you study the location, again, it's about location.
Location.
Right? Population density, business, commercial activities in that area. It can give you, for example, if you're buying something in Mississauga, near Square One,
right?
For example, right? I mean, you're likely not miss it.
Because there's a demand for that neighbor. I get what you're saying.
There's a demand for it. You're likely not miss it, right?
But trying to assign something in the, like I see projects, pre-construction projects, like out on the outskirts, outskirts of like Hamilton, or you're like Sudbury or something. Yeah, it gets tricky.
Yeah,
it gets tricky when you're trying to assign projects.
So you need to be able to understand the location and look at the why, as to okay, what do you likely think is going to happen in this environment in the next 2-3 years. Right? What's the current even housing structure? Is there a shortage? Is there going to be a demand? Because right now, like what we're seeing right now in the market right now, it kind of feel like, I'll just give it because we're still going to talk about that. It feels like condos were probably over budgeted or over subscribed.
Condos,
and now, okay, we'll talk about that in the next episode. So don't Let me be a spoiler.
Let's leave condos for their own.
Let's leave condo. So it's very important for you to be able to understand, the current market situation and be able to know what does it look like for you. But if you're able to assign, it's a good deal.
Yeah,
because for me, it's like a solid investment. Instead of you putting your money in an interest savings account or in a TFL, that will give you 3.5%.
So what does assigning? I think we're going to explain what assigning, because so assigning is, let's say Joe buys a property.
Yeah.
You buy a property on paper for, let's say, 600,000 or whatever, and you don't want to wait for the property to be completed. Let's say by like this year, assuming it's going to be done about next year. So we appraise the property at today's value. You bought it at 600, but let's say today it's about 750,000. Then Joe tries to sell it to me for 750,000. I can negotiate and say, no, I want to pay 700.
Yeah.
So what I'll do is I'll just basically reimburse him whatever deposit he has paid down already, and I give him his money, and then I'm now the one that has to close on that property. And why would I do that as an investor is because after doing my numbers, maybe I can see that a current resale property in that neighborhood is selling for about 800 or 850.
Yeah.
So it's still of benefit. He's getting like an additional 100,000, even though he has not even gotten the keys in his hand. And I'm buying the property for a cheaper amount than what I would get if I was to buy a property that was already built. So that's how it's a win-win for both parties.
Yeah. I mean, you can't go wrong. I think for me, it's seasonal and it's location based. Right. If it's a residential area, if it's a business, let me give a good example. I remember there was a property of a client they got in Hamilton about 3 years ago. I wasn't even a realtor then, but now I can relate and kind of understand what kind of went wrong with that transaction.
Yeah.
So the person bought the property with that assumption that the way the GTA was moving, that probably Hamilton might be that the
next spot.
And
realtors were pushing that thing.
Yeah.
I just never. Anyways, let me let you finish.
The Hamilton might be the next.
Right.
The next,
they're like, Toronto is already parked.
It's already parked.
Which might still happen. It might be too soon to say, but it hasn't happened.
So for an investor,
right,
you need to look at which is why I spoke about buy and hold.
Right.
What's your strategy? That's what will determine. It doesn't matter what the market really looks like for you, because if you're familiar with your strategy, clearly you know that, it doesn't really matter. It's up, it's down. I have a clear plan. It's a 3-year, 4-year, 5-year plan.
Right.
I don't intend to eject out of this plan because I can have a...
So you're sticking to your business plan.
You're sticking to my business plan,
Gotcha.
right? And then you can always adjust your cost, in and out. So when they bought the property...
And so just to probe further, was this like a standalone property, or was this a condominium?
Standalone.
Gotcha. Okay.
It was standalone property.
Okay.
And the person didn't buy with any intention of going to live there.
Okay. So it was bought as an investment property.
It was bought as an investment property.
Separate entrance to the basement?
Yes.
Okay.
Yes, but it wasn't finished, of course.
Okay.
So when they bought the property, they couldn't get a list. By the time they closed, things had changed. The market is where it is right now.
Right.
They couldn't get a list. Interest rates
shut up.
And now the person told me the projection was they were looking to pay about 3,000 on a monthly on the property. Right. Now the question is, should it be difficult to find a rent for 3,000? But the location was a challenge.
Where in Hamilton?
It wasn't an urban area.
Outskirts?
It was a rural area. Right?
Do you know what I believe when it comes to? I think, and I might be wrong, but I'll say every time I see a pre-construction project on the outskirts of the suburban area, like it's not like the urban core.
Yeah.
Like it's not like downtown Hamilton or downtown Toronto. More often than not, I would say if you're buying pre-construction projects like that, it should be for your primary residence. But not for investment purposes.
Yeah.
That's just a rule of thumb. It's a bias I personally have. And I'm not saying, like, for instance, when people are buying pre-construction projects in Bradford, in Thorold.
So the question is, what's a business? What's the commercial activity in that area?
There's nothing.
You understand?
Right.
What's the real system in that area?
And you can tell sometimes you can go there and then those people, they don't even have like a grocery store.
Yeah.
So how do you expect a rent, or there's no commute system, or no
that is accessible.
So you need to think about it. Anyway, sorry. It's just...
No, you're pretty much... That's pretty what the situation is, right? It's a complete rural area developing. And I started, so now in hindsight, things got... they had to just... I don't know how... It was a really very bad situation for them. So now, in hindsight now, I can now ask myself and tell myself, I can advise my clients before you buy a property you want to invest into in some location. Because when I ask the person, then now I have to call and say, let's have a chat about that property. Do you have? Is it like, are there schools around? Because I want to understand what was the rationale,
premise.
in which you decided to go buy a rental property. Are there schools? Probably there was school coming up, or maybe it's a good deal. Said no, there was no school. I'm like, okay. Was there like some commercial activities, maybe like a new plant or like a Unilever or like all of those very big CPG companies, building up? Said no, like the just said that it's going to be a booming area. Like it's going to be so fast and things and they give some very good bonus.
Gosh.
And I'm like, okay, so I get it.
Yeah, it was tricky. Right?
Yeah. So people get into a lot of, and don't fall into incentive. You see some condos offering a lot of incentive to say, when you buy, we offer you 1
free
year,
local, free parking,
free 1 year rent.
The question is, why are they offering you that?
Read the fine print.
Why are they offering you that?
You know this thing we always say, terms and conditions apply.
Bros,
whenever I see that thing, right?
Yeah, I'm afraid like
that's where I go to read first. I want to see, and they won't give you terms and conditions. But if you're smart enough, you can request for it. But you know that people like free things. People jump at, why are you offering me 1 year free rent?
Yeah, there's a reason for that.
There's a reason for it.
Yeah,
so as a matter of fact, you should be more concerned about the things they are offering, the free things. Don't just look at it as an immediate.
Because a good project is a good project.
It's a good project.
They don't need to be tricking you with.
Will somebody offer you a free store in downtown Toronto when the market is?
You have to pay
offer you free parking.
Never.
No. Forget about it.
Yeah.
So that's, I think it's very important that.
And can I just touch on that point, that them buying that property might not necessarily have been a bad investment, in the sense that the question is, what was the exit strategy? So that same property, for instance, right? Imagine if they bought that same property. They finished after they closed, they finished the basement, and then their plan was to sell it immediately after. It could still have been a good deal.
Not to hold.
Exactly. Because so the strategy was what might have been wrong, because they bought it with the intention to buy and hold. Meanwhile, maybe it was a property that needed a flipping approach to it.
Yeah.
That being said, I know the government now changed the laws in terms of, if you buy a pre-construction property, they force you to hold it for like 1 year
before you can sell it.
Before you can sell it again. If not, they charge you like taxes on that flip. So I get that part as well. But I'm just saying, maybe a different strategy might have still made that same deal work. Is just what I'm saying.
Yeah. And I think so. So again, which is where you need to frame your strategy and know if you want to hold. The way you went in.
Right.
Think about the way you're going to go out.
Exit strategies,
right? It's very, very key. Either you want to go in fully, stay for a period of time, or you want to sell out. Which is why I also think that when you hedge your risk with other people, don't carry the burden alone. Share the risk. People don't want to share the profits.
Got you. Like, right? So you're saying if you had bought with other people as well.
So see, the thing with investment is, again, the approach is different from a single family or a residential property or first-time home buying, like where you want to stay. It's kind of very, very different.
Yeah.
It's an investment, right? So don't think about it as you want to have it all.
Because investment comes with risk and reward.
Yeah.
So yes, you want a reward, but then you also have to think about the risk side. What
and you want to think about how to distribute the risk. That is it.
Yeah. Even though it means you get in a lesser reward, but at least you should also share the risk.
Yeah.
I get your point.
Yeah. So and I tell people again, if you're going into a property, start thinking about incorporation. That's a very good strategy. Start thinking about incorporating. Yeah, because you want to be able to, again, this is not tax evasion. It's tax avoidance and it's legal.
Right.
Okay, to build a framework, because if it's a investment property, definitely any income you make from it is taxable.
Yep.
As a matter of fact, the rule is this: if it's not incorporated, it will be added to your primary income.
Right, this is not financial or tax advice, but we can, for educational purposes only.
So whatever. So for example, if I have an investment property, and let's say my income is $2, and I report CRA $2 in a year, if I'm being taxed at the effective tax rate of $2, where the $2 falls in,
right,
and I have an investment property that is making me $100,000 in a year, sir, ma, your income is $102,000.
Yeah, minus whatever expenses you have.
Yeah. And then the CRA would add it up together,
and send you your bill.
They will love you and send you your
CRA love letter.
You understand? So which is why if you're thinking about investment strategy, think about is it a one-off thing you want to do? If it's something you want to repeat over and over, you might want to think about incorporating it.
Right.
Now the question might then be, how do you get a finance? when I incorporate as a single.
Yeah, there are lenders that will do that. You let them that you want to buy under a corporation. Yeah,
you don't expect to go through a lender for sure. I mean, the requirements are kind of very different. You probably want to go through a B lender, and then maybe a little bit it's higher interest, but again, it's an investment property, right? Those interests will be you put the burden on the corporation.
Yeah.
Right. So that kind of thing you get deductible from a type of from CRA, right? So don't let's go. If you want some tax avoidance strategy, we'll have that's going to be on our YLJ financial model. Yeah. So we're just coming up. Don't worry. There's so much where
we have a lot for you guys.
This education. We want to fill you up. We want to consume you. We want it to be loaded
with real estate,
with all you need to prosper in this Canada.
Yeah, absolutely.
Type it there. I'm going to prosper.
I will
if
prosper.
If you can, just type it there. Because some people are prospering in this real estate business.
100%.
It's just the hack.
100%.
They just understand how to hack it. And it's nothing fraudulent, to be honest. People think, so people don't believe that you can actually be wealthy legitimately.
Why not? Why
legal. No, you don't have to place no sketchy just
behaviors.
Real estate, if you do it well, straight up, investment, do your numbers well,
good to go.
You'll be fine.
Yeah. I was going to touch on something that came to mind while you were talking. I just remember that investing in real estate also, you can also invest in real estate in forms of like real estate investment trusts.
Yeah.
And mortgage investment corporations. So what that means is you're not buying a physical property, but you're investing in a company that is buying the property. Or building the property. So I remember at some point in my career, I worked for a mortgage investment corporation. So what we would do is we'll collect money from investors, and we give the money that we get from investors to borrowers to use as a second mortgage or as a bridge loan. Let's say someone is trying to buy a property and for whatever reason they are short of cash, and give them that bridge loan for a particular interest rate. They close. Once the cash comes, then they pay back the bridge loan. So I'm saying that to say, like, you as an investor, you can give companies like that money to invest on your behalf. And usually what they do is that they hold your money for like maybe like a 1-year term or 6 months or whatever it might be. And then for that 6 months, they can say, okay, for this 1 year, for this 100,000 you're giving us now, we give you 8% per annum. Yeah. So as a mortgage investment corporation, there are also REITs, real estate investment trusts as well, where you give them money and they use your money to develop condominiums, they use your money to build maybe senior housing and stuff like that.
Yeah, I was going to talk about the senior homes. I mean, that's another very... I mean, it's a very good investment.
So if you don't want to deal with like the everyday tenancy,
you could do
give
that.
Your money to a trusted organization. Trusted is the key word.
Yes,
and
do your due diligence very well.
Due diligence for things
see what they've done. Like, be sure that they have.
Absolutely.
They're not just. Again, I'm not against new entrants.
Right.
But it's up to you. It's
why are you discriminating against new entrants?
No, I said I'm not against. That's what I said. I said I'm not against. Right, so nothing is wrong with being a rookie
or a new company, but
there's nothing wrong.
It's not with your money.
It's just to choose and decide what works best for you and what you think is the best value you can create out of it, right? Because the challenge is that again, everyone was at some point a new entrant, so it's really up to you,
and unfortunately, I believe, and the issue with those organizations sometimes is that there's literally no backing per se.
There's
no CDIC deposit for if you're giving your money to a bank, for instance, the bank is liable for at least to give you back the first 100,000 if anything happens to your money. But organizations like that, there's really no recourse if they lose your money. So that's why due diligence is extremely important.
Very important.
If you're taking that strategy.
Yeah. So I think we've been able to, give some very insightful information. So when it comes to investment, right? Maybe sometime we're probably going to plan a real, probably bring in some other, financial advisor who are experts on the real estate side or mortgage brokers. So what they focus on is on the investment side. So, to be able to just do some
dive deeper
into some situations, give you some signal, just give an idea of what it could look like. Play with some numbers for you, tell you what it could work with, and then we'll be glad to do that. We're out to serve, right? So, few takeaways today is we spoke about your entry strategy and your what
exit
strategy
as well.
We spoke about not over leveraging. It's very, very important. People want to over leverage against the interest rates. It kills straight up. Let me give that. Is it a disclaimer or is it a amber? Is it a clear warning?
Red flag.
It's a red flag. You can leverage, but don't over leverage.
Right.
Be very, very intentional because
you're taking on too much debt to Yeah.
Yes. Probably you buy here, you refinance, you take it off. It's not yet mature. Someone has told you that interest is going to go to like 10% or it's going to come down. Just keep going. I've had people who they had to sell 2 properties.
Right.
Just because of one.
Yeah.
Because they over leverage.
One.
When interest rate, it's like a dog. If it catches up with you in the wrong timing, it's gonna.
Yeah, so that's the and you know why that happens. That happens because what people forget is that real estate is, especially because in Canada and North America as a whole, we run like a mortgage system, right?
Yeah.
So think of it this way: if you are buying a stock, which we call it margin trading, and let's say you had 20,000, but you were very sure that this stock was going to go from whatever it is now to like was going to appreciate by like 10x. So from your brokerage, you borrow some money, you add maybe like 10,000 to your 20,000, and then you buy it. If that stock goes wrong, you will lose your 20,000 and you owe the brokerage money.
Yes.
The real estate is the exact same way. In the sense that you have your down payment, you don't have the rest of the money. So you borrow the mortgage, you take it from other people. If you buy the wrong investment, if it goes sideways, you lose both your down payment and then you still owe the bank money. So it's tricky, but the good side of it is if it goes very well,
it's also
you've also used just 30,000 to make almost like 100.
But in business, right? In business school, right. you don't play with money like that.
Yeah, it's dangerous,
right? So we've spoken about don't over leverage. Right. Cash is king.
Absolutely,
right? I literally see people throwing cash out of the window every day. And when I mean throwing now, I don't mean.
Please where so I can go downstairs and go and catch it.
Like the way the kind of investment they get into and the way they spend, like the way they expect and project revenue. I'm like,
so don't speculate.
Don't speculate. Work with clear facts.
Yeah, numbers, figures, data.
Be very clear about the fundamentals. No hype.
Right.
Don't get deceived by the hype, which is why I said there's no emotion about location. I love Calgary. I'm just giving an example. I love Calgary. I don't like Ontario, Toronto. I love Vancouver. I don't like this. When it comes to investment, even if it's inside the hole, as long as it's legit, it's legal, that is what it is.
The numbers make sense.
The numbers make sense. So don't look at the fundamentals. Don't look at the hype. Don't look at, again, be very informative about, like, if you don't like news about business, you might want to get in, there's a lot of newsletter you can subscribe, a lot of podcasts you can subscribe that speak about investment that teaches you.
Like the YRJ podcast.
Like the YRJ podcast, what you need to know about investment, and again, always plan for the worst case. Yeah. Which is why
scenario planning.
I always encourage long-term investment. There's always the king. For me, that's
real estate, it's the safest, really. Safest.
That's my approach.
Yeah, 10 year. Let's think of real estate as a 10-year lifespan. Worst case, if you're more aggressive, 5 years, but not less than that.
Yeah,
not less than that. If you have to do less than that, then you need to be very, 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 very. I mean, about 90 or 95% sure that it's gonna produce what you think it's gonna produce. But aside from that, if you want to play safe, 5-year, 10-year span is what we should be thinking about real estate investment.
For sure. I hope we've been able to. I mean, you probably got one or two, information, that you find very insightful and very useful. Today. So join us. We've been speaking about condo. Yeah, so you don't want to miss this next episode. We're going to be, focusing so much. What exactly is happening in Toronto? What's happening?
In the condo market.
What's happening in the condo market? Is it going down? Is it going up? Has it crashed?
Tune into the next episode of the YRJ podcast.
Still with you today on YRJ. I'm Joe.
And I'm Nasser.
See you next time.
Take care, guys.